Partners, internal team members, friends and family of Rocket Pro, welcome to this edition of Pro Performance. And spring is in the air across the country. That means it's purchase season. Very relevant topic coming to you today, saving the deal and rescuing loans before they die. And I am joined with a very powerful partner and have the privilege of introducing Ray Edwards, 47 years in the mortgage industry, helping clients and building a business. And we're going to share some best practices and learn from Ray. My name is Noah Weiss. I am a senior divisional vice president, 20 years at Rocket Companies. It'll be 21 in July. And I spent a majority of my time here helping, developing the purchase side of the business and our mortgage professionals and that side of the house. And just recently joined the Rocket Pro team to double down on our push to grow our broker partnerships and business. So I couldn't be more excited to be with you, Ray. I don't know if there's a couple things that you want to say to introduce yourself to the group. We'd love to hear it.
Not much. You said how long I've been in the business. I've been a broker since 1990. Best job in the world. It's a lot of fun. Meet a lot of interesting people, and you get to help them with something important in their lives.
It is life-changing work that we do. Love to hear that from you, Ray. And we are here to change, hopefully, the way that you all do business in the most positive ways. And that starts with our partner promises. And we've delivered those 10 promises. We'll continue to deliver on those 10 promises and really focused this series, Pro Performance, on number 10. The better we serve you, the better you serve your clients. And doing that through learning from each other and experienced partners and brokers like Ray, and also leveraging and sharing the tools that we continue to build and deploy to help your business and clients thrive. That said, we do have some outcomes that will fall under the umbrella of this promise today. And when it comes to saving deals and recognizing challenges on purchase transactions early, really a four-step process, right? Number one is recognition and recognizing what are the most common reasons and trends in the current market that purchase deals are getting held up or falling apart, right? And we want to get in front of that. Applying a structured framework to your business to diagnose these challenges and again, stay proactive and in front of them. And then evaluating really the levers that we can pull, credit, income, property, assets that keep deals moving forward. And lastly, how do we put all that in and demonstrate great communication? Because we know that our clients and the other client, the real estate agent, deserve and appreciate that crystal clear communication throughout, such as Ray said, an emotional and big time transaction that's happening in a person's life. So we're going to dive right in, Ray, and I'm excited to hear from you. And we talked in pre-work of really going back to the basics, and we're going to start at a basic level and just hearing from you and talking really about when and what and why these challenges do arise. What do you think and what do you see in the current market that are the most common reasons and trends that deals are falling apart in the purchase side of the business?
Well, I think as you kind of mentioned in your opening, deals fall apart because of one of three issues. Something pertaining to the property, particularly the condition or the appraisal, something having to do with the borrower's income, or something having to do with their credit. And hopefully we can identify some tools here that can help address those early on.
Yeah, and we talked quite a bit too. And it's probably not a secret, but we've got obviously experience levels all over in the audience, and some folks maybe just get into the business. But when in the purchase timeline do challenges most typically arise?
Well, one of the things we talked about is that about getting back to the basics is sometimes I know I've done this. I've been in this business a long time, and periodically I find that I get lazy. And when I get lazy, it's like I start cutting corners. So I get somebody's pay stub and I throw it in the file. I get their credit report, I throw it in the file. And I don't bank statements. I just put them in the file. I don't delve into the details. And that's usually when I find that a problem that arises later on was there all along, and I could have identified it if I'd paid attention. So uh, looking at those pay stubs, evaluating them, make sure that you cover all of the things. If you have a problem where somebody's not a straight W-2 salaried employee, it might be a good time to have an underwriter go through Rocket Connect or something to look at the income, looking at their bank statements and making sure that there aren't issues that you have to deal with. Are there large deposits? Are there any recurring activities on that the on your bank statement that an underwriter might look at as a debt? And do you have to deal with that? Make sure that we're covering all of those kinds of things so that we don't it doesn't catch up to us. And then the credit report, of course, making sure that we look beyond the credit score. What are those trade lines? Is there anything that we can work on if they're not making ratios? Is there something we can look to pay off or pay down that can solve some of those problems?
I think you bring up some great points, right? And sure. You mentioned the word lazy, and that happens from time to time for a varying amount of reasons. But also, I think the purchase transaction is unique in the fact that it has a longer timeline. And quite frankly, right, there's this pre-approval stage that you don't see on a refinance transaction. And the client's got some time, we got some time, and you pull in outside forces. It's such a fast-paced world that we live in that maybe we are going fast, Ray. But what you underlined is even at the pre-approval stage and at first conversation, slowing down to take the time to reviewing the income, credit, bank statements, and asking those important questions. And we're going to delve into that a little bit deeper. But I do just want to call that out and recognize it because I think it's very common across the industry. And for a long time in my selling career, I mean, there's a line that comes to mind that pre-approval isn't worth the paper that it was written on because X, Y, and Z, right? And hopefully, as a industry, we're moving away from that, with tools that we offer, such as the verified approval and putting that work up front, because there's an old adage that I shared with you. What's easy to do in the beginning is often hard to do in the end, and vice versa. What's hard in the beginning can often be easier in the end. And I think that's exactly what you're speaking to. So take it from 47 years of experience that being proactive and catching those things early, it matters. And we're going to talk a little bit about why, but transitioning down and really looking at that diagnosing. You mentioned a couple things, but when you are diagnosing risk, maybe some of the most common things that you find in conversations you have and how that looks and sounds.
Well, you know, again, in our previous conversations, we talked about anytime we have an excuse to talk to the borrower or realtor is a good one. So I think it's very important that we can stay in constant communication with them, but we also have to start and lay a good groundwork in the beginning. We need to make sure that they understand the process. I personally like to explain to a borrower what we're going to be looking for as far as things like debt to income, how we're going to look at their income, what we're going to look at their debts, so that they have some basic concept of what it is that I'm going to be looking at so that I'm not sitting here playing with my computer, writing down numbers, and then coming back and say, oh, well, you don't qualify because your debt to income is 52%. And they'll say, what the heck is a debt to income? So if I explain that to them up front, it builds that rapport. It makes them comfortable. Nothing is going to hurt your credibility more than writing a pre-qual letter that you can't honor later on because you missed something.
Education is important, right? And yeah, we did go deep here because when you educate, it not only puts your and empowers your borrower to understand and be part of the process, which I think builds trust, right? Is a word
Yes.
that we throw around in these purchase transactions. So you need that up front, but then if you have to come back and we were borderline and redlining in one key qualifying area, it makes that conversation that much easier, right? Because we're not just introducing and blindsiding folks.
Yeah, and when we identify a problem, it's not just saying, "Hey, here's a problem," but having a potential solution in mind. If somebody's debt to income is a little bit high, is there something we could do that might solve it? A good example would be you've got somebody who's putting 20% down on a property, and they are on a conventional loan. Maybe they're coming in at above 50% on the debt to income. Perhaps you can lower the down payment a little bit. Yeah, you'd have to have mortgage insurance, but by paying down some debt, you might increase the credit score, which would give you better pricing, but you also can get your debt to income ratio in line. So you're coming to the borrower, here's a problem, but here's a solution that we can do.
Yeah, and we talked a little bit about this, and we're going to continue going deeper and transitioning this to even more levers that you can pull when these things arise. But you and I talked, and it's not a total loss if you get to a point and now's not the time. Maybe it's very direct and there's a bankruptcy that needs seasoning. Maybe to your point, there's some income things going on. We talked about like, trailing income and having to wait for things to settle down. But that deal's not necessarily dead up front if we come up with a good plan for our borrowers. And this is something that you've implemented in your business over the years. You want to talk about that a little bit?
Yeah, we always, as loan originators, we're always worried about where our next deal is going to come from. Well, very often that next deal is sitting right there on your desk. You've got somebody who's not quite fitting into the criteria, or maybe they have a certain goal in mind. They want their house payment to not exceed a certain amount. Well, we can figure out what that's going to take, and then so maybe I've had situations in the past where I've met with borrowers that didn't qualify. We came up with a plan and we implemented that plan to get them either 60, 90 days down the road, 6 months. One, I met with a borrower that we came up with a year time frame. And we said, okay, here's what we got to do. We got to pay down some debt. We got to increase the savings. And we were actually able to put that in place. And we were able to actually get that borrower into a home in 9 months instead of, even though we had a plan that was going to take a year. But it's a great opportunity to stay in contact with them, stay in contact with their agent, or if they don't have an agent, refer them to an agent. Better what a better referral is that than to be able to send a realtor a pre-approved borrower.
I couldn't agree more. And I think, as we advance with technology and AI, and I mentioned the pace of business in the world as a whole, these are things that become unique, maybe. Always been that nurturing process, a differentiator in business, and you could call it persistence as well, right? And that's always been tried and true. But I think it's going to start to stand out even more as we start to see just the pace of the world with technology and AI. We talked about that a bit, but you're spot on. I mean, when you and let's face it, not a lot of these folks are coming in with signed contract in hand. Most were pre-approving, and then they got to go through the 1, 2, 3, 6 month process of finding a house. But to this example, maybe they're not even there yet, and you got to do some more work, and you come up with a plan to get the income in line. You come up with a plan to improve their credit, whatever it may be. That client, in my experience, in yours, is extremely loyal, and they're more probable to refer business, and they'll remember you probably for their lifetime, and that feels good, and that's business done right. So
Yeah, it's funny that you mentioned that because since our last conversation a few days ago, I got a call from somebody who said, "Oh, we want to buy a house, but we know that we're not in a position to buy a house yet because we've got to work on our credit, things like that. So we talked a little bit, and we talked about some of the tools that we can use to figure out where they are and what we need to do to get them where they need to be. And so they were happy that I was willing to spend that time with them. But I took it to the next stage because I said, okay, now let's get together and go through this. And how about if I come to you? So I offered to come to their home and sit with them in the environment that they're more comfortable in, because that's going to build that rapport. And I'll never lose those clients. They'll be mine forever, and we'll get them to a position where they can buy. And now I'll have a great referral that I can give to one of my real estate partners.
Trust
So,
so important in a purchase transaction. There's plenty of stories that I believe our clients hear from their friends, family, coworkers that have just ended badly with moving trucks packed and this and that. And you're literally going into their current environment situation and building that trust. So not surprised to
yeah.
hear that, knowing you, and love to hear it. Let's stay on this track. And we talk about levers, and we kind of explored income a bit. um, you and I talked about the property, and who knows what the rest of the year will bring, but a lot of sources saying we're leaning into a seller's market again, um, as affordability has its challenges and supply and demand is doing its thing. You have been leveraging one of our tools, the Property Hub, and I think
Yes.
having some conversations around that to help set proper expectations, pull your agents in. You want to talk to the audience about that a bit and how you're using that to set you up for success?
Yes, I love that Property Hub tool. So when I get a transaction, they have agreed on a sales price, but the market in many places, the market has been softening a little bit, and some of the property values have been decreasing or not increasing as much as people would like to think that it has. So when I get that contract, the first thing that I do is go to the Property Hub and I look up that property and I see what kind of range of values it's giving me. If it's in line with the contract, great, then we're ready to go. If it's not in line with the contract, then I print out the report from the Property Hub and I go to the realtors, the selling agent, and the listing agent, and say, hey, here's what I'm seeing. Is there something that we're missing that will support the sales price? Because we might have an issue when we come to the appraisal. And it's a great opportunity to build your relationship with your realtors. And it gives you a lot of credibility because you're helping them keep their deal together.
Yeah, and I think it goes back to also one of those first principles we talked about of just introducing a potential challenge before you have to have that blindsided call, right? Because you may find out as the originator that the buyer's agent had the exact same conversation, but this client's head over heels with the house. They're coming in over asking, and they just don't want to lose. And we're going after it, Ray. Oh yeah, and we talked about what happens if the appraisal comes in lighter, and they do have up to, I'm just throwing numbers out, 20,000 in reserves that they're willing to bring in to make the deal right and close on the home. That's how much they love it, and we know where we stand. On the flip side, there may not be a plan B, and it may not, we may have to negotiate in a different way. But the fact of the matter is, you're in front of it. That conversation is easier for you as the originator, and you've got your T's crossed and your I's dotted, as we like to say,
Yeah.
right? So appreciate that. We also talked a little bit about the uh, the credit, right? And what has at times, and listen, there's ebbs and flows, much like the mortgage market as a whole, of how we look at credit. We have opened up recently some FICO for purchase transactions, which is exciting for us originators. But you've leveraged through the years, and there's different ways to leverage our credit upgrade resource. And I'd love to hear from you on how you've used that tool and how it's helped you find wins in the market.
Yeah, so while we're talking about credit, it's important that we look beyond the credit report for what liabilities they have. Sometimes things like I mentioned on the bank statement, if there's some recurring payment to the same entity, underwriter might ask about that as, is that a debt that's not showing up on the credit report? Sometimes debts show up on pay stubs. Um, there might be some auto deduct for something that is really a debt that needs to be factored in. But I really like your credit review tool. Um, Even on borrowers that have a high score, you pull credit on someone and you've got a 740, 750 credit score. You say, super, I got a solid deal, this is going to go. They got 20% down, they're at a 40% debt to income, we're in great shape, this is on cruise control. Well, sometimes you can do a better deal if you run that through the credit upgrade process. You might identify a way to get them up to a higher score that would actually change some of your loan level price adjustments, maybe even get them a credit. So that's a great tool when you can go back to your borrower and say, I found a way that we might be able to get you a better price on your loan. Um, Even if the rate's locked in, even if you have it locked in, if you can increase the credit score, that will improve their pricing through that process. So I just think that's a great tool to use no matter where you are
Yeah,
in
listen,
the process.
yeah, and no cost to our broker community, right? We've got a whole team of credit professionals that are running this through a model and helping communicate with your client on where they can get the most bang for their buck, for lack of a better phrase, in repairing the credit. I say repair with caution because what Ray just said was more than just repair, right? And that might need to be the case. We might be in a position where we got to get to that minimum level. But I love what you brought up, Ray, in looking at ways to drop some of the LLPAs and make the pricing more advantageous, because that what that really does is unlock buying power on the top end of your purchase price. Right now you have more affordability built in, and it's going to feel good to be a hero too. Everybody wants the highest credit score. That's like a trigger word
Yeah,
out there,
yeah.
right? My FICO, like it's known in the community now and through our clients. So I love that you brought that up. And uh, you know, on on the other side of it too, not only the LLPAs and being the hero, but you can also look at different clients in different situations, and it can also help with our down payment. Not only the buying power, but you might
Mm.
unlock a minimum down payment, keep more cash in their pocket, all kinds of wins. So I love what you said about leveraging our mighty credit upgrade team.
Got a deal in with you right now that the borrower was coming in with 20% down. He's got a 750 FICO. I ran it through the credit review, the credit upgrade, and they said it was going to cost him $15,000 to pay down some debt, and it would get him up to a 780. And when I ran that by him and we spent a few minutes and we went through and we looked at, okay, here's what it will change. Here's what the pricing differential is going to be. Yeah, we'll have a little bit of MI on this, but the loan was big enough to where it was going to change from an 80 to an 85%. The MI is minimal. It just made all the sense in the world to go that route. So, and that's something that we just did like 2 weeks ago. So.
That's beautiful. It's beautiful. I want to transition a bit. We've talked about some levers, income, credit, property, assets, the way that you're leveraging tools and your own experience to put your borrowers in the best position. Um, One thing that really in moving to the Rocket Pro team that has just I've been amazed with is the experience and the communication and the accessibility of our underwriting team. Our crew leaders are here for you in the trenches. Sure, we've got tools and technology where you can get into Pathfinder and look at the guidelines they're looking at, but what's faster when you need them and you're mobile than being able to either connect digitally with our underwriting team or through the hotline. I'm curious, when and how often you're pulling in underwriters and the experience you've had with our Rocket Pro team and how it relates to solving some of these challenges.
That's funny, because I've got a deal that's actually signing today and funding tomorrow that we did exactly that on. Um, the underwriter was great. He was, but we just had a slight difference of opinion on one of the issues, and I was nervous to push that to a higher level, uh, because I didn't want to offend him. I didn't want to hurt his feelings or have him be mad at me. I talked to my account executive, and my account executive said, "Oh no, just don't even be concerned about that. This is a great learning experience for us." And we were able to get through that process and solve that income calculation issue, and everybody's remained friends. And so, don't look at that as a negative, but look at it as a tool that you've got in your belt. There's a couple of levels that you can push your files up to a higher level if need be. You mentioned the crew leader. I think there's a higher level underwriter in between the crew leader and your file underwriter that you can also go to. Those are tools, and I think what I really like about the environment at Rocket is that you guys instill in your underwriters that this is a tool that can be used, not that it's a negative. So nobody's going to get a black mark on their files or on their name if a file gets pushed up to a higher level. It's just everybody comes away great. We were able to save a deal.
Yeah, we have an ism. We are the they. There is no they. It's just one team, and
Yeah.
you've experienced that, and I love to hear it. As we talk about that underwriting team too, and you and I have talked. It sounds like your philosophy is leverage those folks in that team early and often.
Yes.
And emphasis on some of the early too. Yes, there's going to be challenges that arise, and you know you're going to you're going to feel that. Clients are going to feel that. Agents are going to feel that. So to have that lifeline with some urgency is always what we want and need. But also, as you're getting creative, or as you're listening to Ray and he's talking about, you know, reviewing bank statements and seeing NSF charges or different debts on there, and he's got 47 years of reviewing credit reports. Maybe you don't. Well, these folks and these underwriters have been in the business a very long time, and this is their sole focus. So, being proactive with that, if the loan's registered, you've got access to these tools, and folks will help you get through, so you can do the important stuff early in the process. So, I think that's worth mentioning. But love to hear you leveraging our powerful underwriting team. We can do it without them. So, our
Yeah.
AEs are super powerful and well versed. But right behind them is that team of powerful underwriters. I do want to
There,
talk to you, Ray, and wrap up a bit on what you can leave the audience with, and that being maybe some very specific and high level habits that you have daily, and or any systems or strategies that you put into play that really speak to saving these deals and getting in front of the challenges on purchases before they arise and become a problem.
there's take your blinders off. There's all kinds of things that you can do out there. One of the things we haven't hit on is sometimes if you got a debt to income ratio, can you add a co-borrower? Sometimes when your loan level price adjustments are really dinging you because maybe you got a borrower and a co-borrower that one of them has a really high credit score and one has a low credit score. Maybe you can take one of them off of the loan. They can still be on title. So maybe the spouse with the lower credit score you can take off of the loan. They can remain on title, but you're going to price the loan based on the one with the higher FICO score. If the person with a higher FICO score has got the income and can make ratios, that's a great tool to improve the pricing. If you can again go back to your borrower and say, "Hey, I found a way that you can get a better rate uh, I've used that tool many times, and I've never yet had somebody tell me no. Um, we want to remain on the loan as long as they're on the title. So that's a great tool. So be creative. I think that your account executive is a wonderful tool. They're experienced people. I can tell you that even with 47 years of being in the business, sometimes you forget about things. And my account executive has said, "Hey, what about this? Did you consider this?" No, I missed that. Thanks. Thanks for the heads up. So lots of good
Awesome.
opportunities.
Yeah, awesome strategies laid out by Ray. I appreciate your time today. I appreciate your experience and telling some stories of your experience, not only with clients in the marketplace, but with our team here. And you are a true partner. We're glad to serve you, my friend. So thank you so much.
I can tell you that most of this has come from mistakes that I've made. So, you know, anyway, but I thank you for giving me this opportunity. I hope I've been able to encourage somebody. Hope I've been able to help somebody.
Well, yeah, and I'm sure you have. And those mistakes are learning lessons, right? We don't win
Yep.
or lose. We just win or learn. And I think
Yep.
that is a great philosophy, and you're living it, and you've been living it. It's been a pleasure. I'm going to wrap up. I do want to recap some of the resources that Ray and I talked about just to keep them in front of the group. And I want to recap some of our takeaways, but resources that we did talk about, your support system that you have here, not only in the broker community with your peers like Ray, but at Rocket Pro and what we're building and what we'll continue to build and serve. We mentioned Rocket Connect, a way to digitally transact with our underwriting team. Now, not listed and more my flavor because I always have a follow-up question or two or three. If you know me, you know that. But we have our broker partner hotline where you can call directly in and talk to our underwriting team, our closing team, whatever you may need to get in front of that challenge. You've got access to the Pathfinder tool, which is all of our guidelines and overlays that our underwriters are working off of. And you can have that knowledge at your fingertips, mobile or otherwise. We've got Property Hub, which we went deep on to help you understand the market, understand the value and where homes are selling on some of the deals that you are desking. And then Ray mentioned, and I'll mention, the most proud part of these resources are account executives. And very intentionally, this team was built years ago with top level loan originators who were originating for a lengthy tenure and now have transitioned and taken that knowledge to help serve and support you. So leverage that account executive, and Ray teed me up for that one. Thank you. All right, as we review and you walk away, a reminder of where we started in full circle. We talked about ways to recognize the most common reasons purchase deals fall apart. We spent some time on income, property, assets, and credit, the tools and tips and tricks from Ray that help us first understand what's going on and then apply structured framework to diagnose those problems, leading to our ability to evaluate, get creative, possibly tap in some of the resources that we have and we've covered. And then last but not least, demonstrate effective communication to our clients and our real estate agents who desperately need to be in the loop as well, because they're as big a part of the transaction as any of us. It takes all three parties to create an awesome experience. As you do walk away, what can you put into action? Well, take those four things and get into your active pipeline. Maybe as Ray and I were talking, you go, ooh, yeah, I just put a pre-approval one last week that I might want to go back and look at that income because it was coming in from a bunch of different spots. Or I need to possibly dig on those bank statements that I haven't received, but I sent out the pre-approval and conditioned for that. Whatever it may be, think about your current pipeline and those high risk loans and get in front of it. That's step one. Step two, obviously diagnose, understand exactly what we're dealing with, and use the tools and inches around you that you need to get the deal back on track. And or that'll lead you to step three, which is resetting or setting the proper borrower and agent expectations early in your process. So take that with you. And I appreciate you all tuning in. It's been my pleasure to host this edition of Pro Performance. April 23rd, we're going to continue on this track. It is purchase season. And sometimes deals can get stalled, not because of income, property, assets, credit, maybe before they even start. Maybe we do transition into a seller market. Maybe there's some emotion and things holding our clients back. Maybe it just goes no, and we got to implement great follow-up communication and how the follow-up in purchase season works to help drive more business, nurture that business. We touched on a little bit of that. What does that look like in action? You'll want to know, you'll want to find out, and we're going to talk about it. So join us April 23rd. Thank all of you and have a fantastic day. Again, my pleasure. And we're glad to be a partner and proud to be a partner to each and every one of you. Thank you.